Over 65 with a paid-off home. Before you ever think about selling it, there is a tax most seniors never see coming. One that can take a six-figure bite out of the home you spent a lifetime paying off. If you have already seen the video on this channel about what Medicaid can do to a paid-off home, know that this is the other side of that same story. That danger comes from the nursing home and the state, reaching for your home to pay for care. This one is completely separate. It comes from the tax collector, the day you decide to sell the home yourself. Same house, two very different threats, and most seniors never see either one coming until it is too late. And there is a new plan moving through Congress right now that could erase this one for good. So here is the trap, who it hits the hardest, and the change that could save you tens of thousands of dollars. Start with the trap itself, because almost no one is warned about it until the sale is done. When you sell your main home for more than you paid, the profit is called a capital gain, and the government can tax it. There is a break that protects part of it. If you are single, the first $250,000 of profit is tax-free. If you are married, it is $500,000. Anything above that line is taxable. For most people who bought recently, that sounds like plenty. But think about a senior who bought a home decades ago. Say they paid $50,000 for it in the 1970s, and today it is worth $500,000. That is a gain of $450,000. A single owner subtracts their $250,000 exclusion and is left with $200,000 fully taxable. The bill on that can easily run past $30,000, sometimes far more, on a home they already owned free and clear. And the federal tax is not always the end of it. Many states charge their own capital gains tax on top. And for higher income sellers, there can be an extra federal surcharge as well. So the true bite is often larger than the headline number suggests. There is also a hidden ripple most sellers never anticipate. A large gain from selling your home counts as income for that 1 year, even though it is a once-in-a-lifetime event. That single spike can push you from a lower capital gains rate into a higher one, and it can quietly raise your Medicare premiums about 2 years down the road, because those premiums are set by your income. So a senior who sells a long-held home can end up paying more for Medicare in a later year, purely because of a one-time sale. It is worth knowing before you sign, not after the surcharge letter shows up in the mail. That is the cruel twist. The people hit hardest by this tax are not the wealthy. They are the long-time owners. The retiree who did everything right, bought a modest home, stayed put for 40 years, and watched the neighborhood around them climb in value. Their reward for a lifetime of stability is the biggest tax bill of all when they finally need to sell and downsize. And that fear has a name now. Economists call it the lock-in effect. Millions of older homeowners are staying in houses that are too big, too costly to maintain, or too far from family, simply because the tax on selling feels like a wall they cannot get over. The very break that was meant to protect them has not kept pace with decades of rising home values. So a limit set long ago now falls short for exactly the people who need it most. And this is not a small or shrinking group. Housing researchers estimate that more than a third of American homeowners, nearly 30 million households, already have enough gain in their homes to blow past the $250,000 limit, and millions more are already over the $500,000 mark for couples. Here is the reason. That exclusion was written into law back in 1997, when the typical American home cost only about $130,000. It has never once been raised for inflation in all the years since. So a break that comfortably covered almost everyone 3 decades ago now leaves a growing wave of ordinary, long-time owners exposed. And that number climbs higher every year that home prices rise. Now here is the group it punishes the most, and it is one this channel hears from constantly. Widows and widowers. While both spouses are alive, a married couple gets the full $500,000 exclusion. But when one spouse dies, the clock starts on a rule almost no one knows. The survivor keeps that full $500,000 only if they sell within 2 years of the death. Miss that window, and the exclusion drops to $250,000, the single amount. So a grieving spouse who waits too long to sell, because moving is the last thing on their mind after a loss, can lose an extra $250,000 of protection and owe tax they would never have owed if they had understood the timing. Picture a widow, 74, in the home she and her husband bought for $60,000 and raised their children in. It is worth $600,000 now. For 3 years after he passes, she cannot bring herself to sell it, and no one ever tells her about the clock. When she finally does, she is treated as a single seller. Instead of $500,000 of protection, she gets $250,000 and owes tax on the difference. A sale made late and made in grief quietly costs her tens of thousands of dollars that a single conversation could have saved. There is one piece of good news buried in the tax code that softens this, and you need to know it. When a spouse dies, the home usually gets what is called a step-up in basis on their half, or in some states, the whole home. In plain terms, the starting point for the tax resets closer to the home's current value on the day of death. That can wipe out much of the gain, but only if the survivor understands it and sells while the numbers still work in their favor. This is exactly why the year after a spouse passes is the worst possible time to make a rushed decision, or to make no decision at all. So why is all of this suddenly in the news, with headlines about a new plan for homeowners over 60? Because Washington has finally noticed the problem, and there are real bills on the table to fix it. The one getting the most attention is called the Nest Egg Protection Act. It was introduced in Congress in the middle of this year, and here is what it would do. For homeowners aged 65 and older who have owned their home as a primary residence for at least 25 years, it would raise that capital gains exclusion all the way up to $1 million for singles and married couples alike. That is not a small tweak. For a long-time owner sitting on decades of appreciation, it could mean the difference between a $30,000 or $40,000 tax bill and owing nothing at all. There is a second, even bolder proposal. A separate bill would remove the dollar caps entirely on a primary home. No $250,000, no $500,000, simply no federal capital gains tax when you sell the place you actually live in. It carves out rental properties and house flips, so it is aimed squarely at ordinary homeowners, not investors. But here is the part you must hear clearly, because this is where excitement turns into a costly mistake. Neither of these has become law. They are proposals, sitting in committee. As of right now, the rules have not changed one bit. The exclusion is still $250,000 for singles and $500,000 for married couples, and not a dollar more. Anyone who sells a home today counting on a break that has not passed is making a serious error. And even the Nest Egg Protection Act, if it does pass, is written to apply only for a set stretch of years later this decade, not forever. So do not sell your home based on a headline. A bill that has a nice name and a sponsor is not the same as a law you can rely on. Watch it, hope for it, even call your representative about it. But plan your actual sale around the rules that exist today. Which brings us to what you can actually do right now, under the law as it stands, to keep this tax from ambushing you. First, know the 2-year rule cold if you are a surviving spouse. If you have lost your husband or wife and you know the home will eventually be sold, understand that selling within 2 years of the death protects the full $500,000 exclusion. And get advice on the step-up in basis before that window closes. This one piece of timing can be worth $250,000. And if life forces an early sale, do not assume the break is simply lost. Even someone who has not lived in the home for the full 2 years may still qualify for a partial exclusion when the sale is driven by a health problem, a move into care, or another genuine hardship they did not see coming. It is a narrow door, but for a senior selling because of a diagnosis or a move into assisted living, it can be worth a great deal. And a tax professional can tell you quickly whether you fit through it. Second, dig up every record of money you ever put into the house. This is the step almost everyone skips, and it is worth a fortune. The tax is on your profit, and your profit is the sale price minus what you paid, plus every major improvement you made over the years. A new roof, an addition, a remodeled kitchen, a new septic system, all of it raises your starting point and shrinks the taxable gain. 40 years of receipts in a shoebox can knock tens of thousands of dollars off the bill. If you never kept them, a tax professional can still help you reconstruct a reasonable basis. And be generous about what counts. It is not only the big remodels. A new roof, replacement windows, a deck, a new driveway, central air, a finished basement, even major landscaping and special assessments can all raise your starting point. Routine repairs like a coat of paint do not count, but permanent improvements do, and across 40 years, they add up to real money knocked off the bill. Third, understand the difference between selling and passing the home on. If you sell while you are alive, you face this capital gains tax. But if the home passes to your children when you die, they receive that step up in basis, and the gain that built up over your lifetime can vanish entirely for them. For some families, staying in the home and letting the children inherit it is far cheaper than selling late in life. For others, the need to downsize or free up cash makes selling the right move. There is no single answer, only the right one for your situation, and it is worth running the numbers before you decide. Fourth, if you are anywhere near these limits, do not sell without talking to a tax professional first, not after. Once the sale closes, the tax is locked in. Beforehand, there are often ways to time the sale, use the improvements, and structure things to stay under the line or soften the hit. An hour with a tax advisor before you list the home can save you more than that advisor costs many times over. So here's the whole picture, plain and simple. If you are a senior with a paid-off home that has climbed in value, selling it can trigger a capital gains tax that surprises people every single year. And it falls hardest on the longest, most loyal owners, and on widows who miss a 2-year window. There are real bills in Congress that could shrink or erase that tax, including one that would lift the exclusion to a full $1 million for older long-term owners. But not one of them is law yet, so today's rules are the only ones you can plan around. The homeowners who keep the most are not the ones who guessed right on a headline. They are the ones who knew the rules, kept their records, watched the timing, and asked a professional one question before they signed, instead of 1 year after. A final note that matters. This is general information, not tax or legal advice, and the bills described here are proposals that may change or never pass. The right move depends on your state, your numbers, and your own family. Before selling a home that has gained significant value, sit down with a tax professional and look at your specific situation. While there is still time to plan it, rather than discovering the bill after the sale is already done.